Hey everybody, welcome. Thanks for tuning in. My name is Matthew. Today we're going to continue our money supply series. We're going to break down the M2 money supply of the United States. All right. So here we are continuing to build out the money supply for the United States, and we're going to look at M2. Now, you remember from last video when we built out the M1 money supply, that is, we added M0, which is physical cash outside of bank vaults, plus demand deposits, that is, every single checkable deposit, checking account that is basically on demand for United States citizens and United States bank account holders. Those two items put together equal M1. And typically M1 and certainly M0, they are thought of as the most liquid type of monetary instruments. And as you remember from the last video, we go up the stack from M0 to M1, M2, M3. And the idea is that the most liquid assets, most liquid monetary assets, the things that we call money, are in M0 and M1, and the less liquid monetary instruments are in M2 and M3. But as I said before, I do think that that's not completely an accurate statement, because there are plenty instruments in M2 and M3, which we'll talk about, which are plenty liquid, very, very liquid, and are counted in those higher monetary stacks, those higher M curves. So I think the better way to look at it actually is monetary instruments that are in M0 and M1, they are actually the most highly regulated instruments. And monetary instruments that are in M2 and M3, and some countries they have M4 money supplies and more. Those instruments are actually, as you go up the stack, the least regulated monetary instruments. So something to keep in mind here. So let's take a look at the chart here. We have this green curve already built for you. The little person there bouncing up this curve as we look over the years. As usual, the United States started to build this out in detail in January 1959, in the 50s and the 60s. Paul Volcker, the chairman of the Fed, in the late 70s, he was one of the people that was instrumental in helping to build out these monetary curves, as were, I'm sure, many other Fed economists that worked at the Fed at the time. And many other nations followed suit, building out money supply curves, trying to get control of the money supply, make it more transparent by tracking it and getting reporting from banks, so on and so forth, and building out what money actually means in a regulated banking system. Now, if the banking system was free and we didn't have a central bank or wasn't regulated, these money supplies would certainly still be there. We just have to go about collecting the data not from one source, but from multiple sources. So yes, it's easier to get track of the money supply, to keep track of it if the central bank is the one entity that is controlling it and getting all of the reporting. But certainly you could do this in a free banking system, and the money supplies would certainly still exist in a free banking system in the absence of a central bank, which I hasten to say we did have in many, many countries, certainly pre-21st century. And as I mentioned before, the Bank of Canada, they didn't have a central bank, and they had one of the most famous free banking systems. They didn't have a central bank until the 1930s. So back to the chart. Here we have savings deposits, and this is part of what we call M2. Okay? M2 is, again, supposedly less liquid than M1, but really what it means is less regulated than M1. The banking system is a highly, highly regulated industry, very strict industry. You may think that's a good thing. I happen to think that's not a good thing. Nonetheless, when you go up these M curves, which we're going to do now, to M2 and to even M3, you're going to see that the instruments are not necessarily less liquid. They're just less regulated. So savings deposits, typically that is an account where you can hold in your bank, and the number of transactions that you could make in the United States would be limited per month. I don't remember the number. It's changed over the years. I think it was even 4 at one time, only 4 transactions you could make. That all changed during the COVID years, actually, during this bounce here in the money supply. Right here in May 2020, see prior videos, the Federal Reserve stopped publishing M1 the way that they should publish it, which is isolating demand deposits, so on and so forth. So if you look at a chart of M1 now, it's almost identical to M2. It's very nonsensical that the Federal Reserve did this. It's pretty asinine, but nonetheless, that's the way that they chose to move forward. Certainly, banks can treat a checking account and a savings account different. They can offer different benefits to holding money in a savings account versus a checking account. But from the perspective of regulations, Regulation D, it changed here during the COVID years. It's not much different. You can spend money in a savings account exactly like you could from the perspective of the regulatory agencies, like you could if it was in a checking account. Nonetheless, traditionally, I'm still breaking it out. I'm still tracking it the way that it should be. I've backed into this savings account number, even though the Federal Reserve doesn't publish it anymore, using other data, and this is how it looks. Traditionally, of course, if we had money in a savings account, unlike a checking account, we could expect higher interest. Yes, we could expect a little bit more restrictions on when and how we could withdraw it or transact with it or spend that money. But we would expect, in return for that, higher interest. And as we know, or maybe you don't know, the Federal Reserve, the central banks around the world, they also control interest rates. And when they control these interest rates, that also affects the incentives or how appealing it might be to hold money in a checking account versus a savings account. We're not going to go into that into this video. We will in future videos. You have to look at interest rates to see how things change there. But nonetheless, something you can keep in mind. So this is the curve. We see, as usual, you see the curve grows faster after the global financial crisis. It seems that people were demanding cash balances, demanding to hold money in banks, increasing their savings rate, which we can look at. They were becoming more cautious after the financial crisis, and a lot of cash went into banks around the United States. So we have here about $120 billion of savings deposits in January 1959. And if we go all the way out to today, we see it's down a little bit from 2020 to early 2022, when all the COVID stimulus checks were coming out, being pumped through the economy, corporate welfare, corporate bailouts, so on and so forth. It's down a little bit from there. We're at $10.2 trillion in savings deposits in the United States, around $10,200 billion of savings deposits. Now, when we count up these M curves, remember, this is M2, and as you see in the subheading there, in the subtitle, this is the non-M1 portion. Okay, so M2 does include M1, and I will show that in the next video. But now we're just going to look at the non-M1 portion, which is, again, cash outside of banks and demand deposits. We've already looked at that in a prior video. So let's just look at the non-M1 portion of M2, because M1 is a subset of M2. That's how it works. So that's what this is. And this is, I can tell you, by far the largest portion of non-M1 M2 money. Let's show the total just to get perspective of that. And there it is, this black line. This is total non-M1 M2 money. Okay, so it's a little bit less regulated than M1. That's really the key to take away. And yes, it's supposedly a little bit less liquid as well. You see, the total here was basically the same. Basically, was all savings deposits as far as it was counted up by the Federal Reserve and reported by banks in January 1959, $119 billion. And just a little bit higher here today. We see that the savings deposit portion as of December 22nd was $10.2 trillion. And the total, the non-M1, M2 money as of December 31st, 2022 is $11.8 trillion. So the vast, vast majority of what we call M2 money, but be careful because M1 is still a subset of M2 money. The non-M1 portion of M2 money is savings deposits. And that remains so today, even if the regulations have changed. You can rely on me to do everything I can to keep historical data consistent, historically backwards compatible, no matter what the Federal Reserve throws at us, resource constraints, all they claim, to not continue to publish transparent money supplies. This is roughly how the savings account balances look in the United States. It's a lot of money. It's a lot of money. And you might recall the M1 portion from the last video was under $10 trillion, about $9.5 trillion in M1. So already the M2 portion, the non-M1 portion of M2, is larger than M1 in totality. Okay, so let's just look very simply then at the gap here, the other remaining money supplies that make up the gap of M2, or more specifically, the non-M1 portion of M2. First one is retail money market funds. There you see it here in a little bit of a lighter green, indicated by the square here, retail money market funds. See, it's only started to be counted here in the 70s. It was nothing before then. 60 billion, 50 billion, climbs a lot here in the 80s, savings and loan crisis. And then we get to a couple hundred billion here in the 90s, and we get to $1 trillion, actually right on the eve of the global financial crisis. And if we go till today, it's about the same, not much more than the global financial crisis. About $1 trillion, little over $1 trillion is retail money market funds. Let's even take off savings just so you can see how it looks alone. This is the retail money market fund portion of non-M1, M2 money. And we can even zoom in. Let's zoom into the 80s and 90s, just before the great financial crisis. So it's not a huge portion here, but still, as we said, it got up to $1 trillion on the eve of the financial crisis. And what does that basically mean? Well, this is money. As you see, it's retail money market funds. This is money that basically, when you sell stock from your brokerage account, whether it's TD Ameritrade, E-Trade, Schwab, Fidelity, so on and so forth, you sell stock and you say, okay, I'm out of stock, I went into cash. This is a way, basically, that our financial system in the United States has built up, which is different, by the way, from other financial systems around the world. Stock purchases can go much more frequently and much more often. In fact, they do, via banks in other parts of the world, as opposed to the United States, where typically if you're buying or selling stock, you're going to do that through a broker, through a entity that is not a bank. So these are brokerage type accounts, and they're not always even managed by the broker. They can be managed by a separate company entirely, a money market fund. And basically, the broker manages the cash, and they manage the cash by collecting a spread. So they'll take the deposits that their stock account clients use when they say they sell stock, and then they have cash. What is that cash? Well, it's balance that the brokerages manage, and they take that balance typically and they themselves invest it into theoretically more liquid assets, more safe assets like government bonds. That's the typical thing, government bonds. And by doing that, they themselves earn a little bit of a spread. They earn some interest where they can collect for profitability. And then on the liability side for them is, of course, their customers, the people that I mentioned. When you and I, if we sell stock, we say that we're in cash, right? If you sell Microsoft stock or something and you go into cash, you see cash on your brokerage account statement. Typically, that's a money market fund. So it's something that's managed by a fund. It's always in the effort to collect interest and profitability. It's not insured like a bank account is insured, like a savings account, like a demand deposit is insured. And that's the balance. So the balance is used basically for retail investors to get in and out of stock with cash purchases and sales. And it's not a huge number relatively compared to the numbers that we've seen, But this is what exists basically, the green shaded area when you say that you're in cash and you're not holding stock, but the balance that you're holding is still with your broker. It's usually in a money market fund. And the key word there, retail, as you see, this is as opposed to institutional. So institutional money market funds will find that in M3. And that, again, is where it doesn't really make sense that it's less liquid, because institutions can be very liquid with their assets, their money market funds, so on and so forth. Nonetheless, retail money market funds are in M2. And again, other central banks around the world typically follow this, but certainly not always, and it gets more vague as you move up the stack of these various M money supplies. So let's put savings back on. We have savings deposits, the vast majority of non-M1, M2, retail money market funds, and now let's add the final component of M2 that we haven't looked at yet, and that is small time deposits. Now this is actually back to a bank, typically. Typically this can be found in a bank, small time deposits. And let's take off savings and retail just to see this one now. You see this one's a little bit more jumpy and way down compared to where it's been around the global financial crisis. It was a little bit more than retail money market funds, 1.4 trillion on the eve of the global financial crisis. And then you see that it fell steadily, all the way till basically today, where it's a few hundred billion, $357 billion of a small time deposit money supply for retail investors in the United States. Let's reset the zoom here. Again, to comment on the retail nature of what M2 is supposed to be. It's supposed to be more retail, liquid, monetary assets. Of course, that's not always the case with small time deposits. They could be small companies that hold time deposits. Nonetheless, this is just how the Federal Reserve counts it out. I believe it's under $100,000 is a small time deposit. And so what is a time deposit? Similar instrument like a money market fund, actually, or even a savings deposit, which I didn't perhaps give a full definition either. This is, again, when you want to hold your money, you want to hold a balance with a bank. And as we learned in prior videos, that does not mean that there's just physical banknotes and coins sitting in a big vault waiting for you to retrieve. No, that's not how the system works. It's a fiduciary system. It's a fractional reserve banking system. And basically, nearly all of the money always is lent out by banks in the effort to pursue interest, to pursue profit. And it's a highly regulated industry. They claim that the regulations stop prior bank runs and prior crises. That's very, very debatable, very, very arguable. I personally don't believe that at all, but nonetheless, that's what they claim. So a time deposit is a very unique type of deposit where, unlike a demand deposit, and unlike even a savings deposit, which now, after Regulation D changed, basically has no difference than checking accounts, as I mentioned, a time deposit is basically where you know that you are depositing this money with the bank in return explicitly for interest, and you won't be able to take the money out until the term ends. So the deposit might be a month, it might be 3 months, it might be 6 months, it might be a year, it might be well over a year. But it is a strictly defined term by the bank where it is very, very clear that you are loaning your money to the bank. You can't take the money out of the deposit, the time deposit, before term comes due. And if you do, there will be a penalty for you to pay, not the bank. And in return for this time deposit account, which what is in it for you if you offer this to the bank, if you deposit your money in the bank into a time deposit account, you should receive higher interest payments than you would in a savings account or a checking account. Sometimes checking accounts pay interest, sometimes not, sometimes they're just free, but that's how it works. So again, not a huge number, and even a smaller number than retail money market funds as of today. But this is an account that you will typically find back in the bank. And again, it's just defined by the Federal Reserve as a small number, meaning under 100,000 denomination time deposits. So typically retail, but it certainly could be small companies as well using small time deposits. So let's put the retail money market funds back, see how they look together. And then, of course, the gap to make the black line of total non-M1, M2 money is savings. And there we have them all together. And this is roughly what non-M1, M2 money looks like. Finally, I'll just put here on the right axis back the savings deposit component. Okay, so here we can see how much the savings deposit component actually made up of the total non-M1, M2 money at any given time. It was actually not that high here in the early 80s, whereas at the beginning of the 50s, it was 100% of the stack. Went down to 90, 80, 70%, 60%, 57% here by the time the gold standard completely collapsed and concluded here, the Nixon shock, August 1971. Savings deposits only made up about 57% of the pie of non-M1, M2 money, and even went as low as 23% here. 23% in July 1982. Small time deposits were $870 billion at the time versus $310 billion for savings. So really, time deposits were very, very popular here. Perhaps the only good way to make a return. And of course, what was happening during this time was Paul Volcker, who I mentioned. He was governor of the Federal Reserve in the late 70s and just at the beginning of the early 80s before he turned it over to Alan Greenspan. But during this time, he had to stop a lot of inflationary pressures that were coming in the economy, the stagflation decade, and he took interest rates to 20%, the base level federal funds rate to 22% in 1980. And that obviously incentivizes you to earn interest and put your money into a bank and perhaps not spend it and tamper inflation. And here you can see people were flowing their money into small time deposits versus a simple savings deposit or a retail money market fund, which anyway wasn't going to be that popular here for the retail investor until the 90s, as we can see, the 2000s, when people started to trade stocks more, would hold retail money market fund balances. And then, of course, you see the savings deposit component of non-M1, M2 climb and climb and climb to it's at basically close to its all-time high today, 87%. Back here was, of course, 100%. But we're back to 1960s levels of the savings deposit portion of the pie of non-M1, M2 money. So that's quite interesting to see. And of course, why would time deposits fall during this time? Well, they're not that attractive to earn yield. We've been in 0%, very, very low in the case of non-federal funds interest rates, but low to 0% interest rate environment since the global financial crisis, excepting a few months here and there when they try to tamper down inflation until now. And indeed, we are seeing the savings rate fall here, the savings deposit account value, I should say, fall here. Perhaps that means that time deposit accounts will increase here, but it doesn't look like it right now. Very, very small balance in time deposits, retail type time deposits versus the past. Still the vast majority in savings deposits. Let's see how that goes as interest rates start to rise and the Federal Reserve tries to cut out the inflation that they have caused ever since the days of Alan Greenspan, certainly, but Ben Bernanke as well, and after the global financial crisis, so on and so forth. So there it is. That is the non-M1 portion of the M2 money supply. In our next video, we will put M1 on and see how M2 actually looks in totality. Thanks a lot for watching. Take care.